are live. Exit Liquidity episode 74, I believe. This week we have Kaledora from Ostium. Thanks so much for joining us.
Great to see you guys. Thanks for having me on.
Fun stuff. Yeah, I think we've been talking about doing this for a while, and we love having unique stuff on people building things that we've never really seen before. So definitely good to get the lowdown on that. To start out would be great to just hear a little bit about who you are, kind of why you're here, what got you into crypto, usual intro stuff.
Sure. Yeah, I mean, excited to be here. I've been a fan for a long time. I think I found you, Ollie, when you had like 400 followers before Exit Liquidity really started. So glad to see we're coming full circle. Cool. So to just maybe give a bit of like background on myself and my story and sort of the founding story of the company before we dig more into, I guess, any technicals. I had a bit of an unusual path to get into crypto. I actually had a first career as a professional ballerina. Started training as a kid, probably before I have any conscious memories. I wound up training to become a professional for 15 years and then was fortunate enough to be able to dance professionally, first with Boston Ballet. I spent a year there, then at the Royal Danish Ballet in Copenhagen. I moved across the Atlantic to Denmark when I was 19 and then spent 4 years there. So that was sort of my first career. I spent probably the first 20 something years of my life just obsessed with ballet and sort of that one single thing. I don't remember a time when I was a kid when I didn't know what I wanted to be. And I guess I feel very fortunate to have had the experience I think like very few people have of having been able to fulfill like a childhood dream in the truest sense of the word. And I think it gave me it. I learned, I think, over the course of like the past, year and a half of being a founder, that there's actually a surprising number of aspects from my first career that have been translatable, but maybe sort of like less in the obvious way, mostly related to, I guess, like grit and sort of dealing with rejection and all that stuff. So I can talk more about that, but I always say the Ballet to crypto pipeline is an N of one, and it turns out maybe more people should try it. So, anyways, that was my sort of my first career and the initial sort of path that I took. At some point, I'd always had like a latent interest in markets. I guess I was kind of a weird kid. I remember reading Thomas Sowell's Economics, Facts, and Fallacies during ballet summer camp, sitting in the dining hall by myself. Raised by pretty libertarian parents, so I was exposed to a lot of sort of Austrian economics from a young age, and I guess sort of knew the world was bigger than what I was doing just in ballet. A lot of which is sort of preserving, an art form that's been around for a few hundred years. And at some point, I decided I wanted to sort of go back to college. So I retired in 2019, wound up going to Harvard. I was a bit older than everybody else and, wasn't entirely sure if I'd make any friends. Wound up sitting across from a very precocious freshman, my first few weeks of school, named Marco, who now is my co-founder. I think the first time we talked, we sat in the lecture hall after an exam review session for 4 or 5 hours and talked about everything, markets, philosophy, politics, everything under the sun. That was sort of the, I guess, birth of our friendship. Sort of going from there, I mentioned this interest in markets. I wound up studying neuroscience and statistics, but spent most of my summers working for various hedge funds. I spent one summer working for a fund called Verdad, mostly just doing research on small cap value equities, sort of the value fund. They did a lot of research sort of built off of like Fama and French. If you're familiar with them, they did a lot of like value equity research, and then also spent a summer working at Bridgewater. I worked under the CIO there, mostly just doing research in the short time I was there on inflation and sort of supply chains. We were looking at sort of trying to project out how inflation would change over the next, year or 2 years. They were very early to the inflation thesis, I think, before it was consensus, and it had a pretty profound impact on how I thought, the next 5 to 10 years in markets would go, and sort of I think what we're starting to see now, which is more persistent inflation and persistently higher interest rates. Marco also spent some time there. We'll give his whole background, but he also spent a summer there as well, working on the commodities team. And then throughout that process, I think sort of slowly and then sort of all at once, we fell down the crypto rabbit hole. We did a lot of this stuff. I always say that people usually do their first cycle. We bought a lot of stuff at the top, We read some white papers. We lost money in Anchor. I think we talked about this before, but you guys, I guess that was the original genesis for the idea, the podcast idea, being Exit Liquidity. I was definitely Exit Liquidity. So we have that in common. And from there, things just sort of snowballed. We had always felt strongly if we wanted to do something in the space that it was something that was somehow tethered or connected to the sort of underlying or non-crypto markets. And what we saw is like sort of a broader macro evolution, influenced, as I said, I think by some of the work that I did at Bridgewater, but also some of the time I spent at the value fund prior. Um, and while also wanting to build something that we thought was like deeply crypto native. So I'll stop there. I can talk more about the Ostium specific journey, but yeah, I'll pause there.
Yeah. Yeah, great stuff. I love hearing about co-founders who met each other in university. I feel like that usually the stories I've heard like that have, turned out pretty well for both parties and just been like a very long lasting relationship. Obviously me and Cedo met because of university as well. So
Yeah.
it's strikes a chord, I think.
We wound up
Before
living
we
in a hacker house after we graduated. He dropped out, I graduated. We wound up living in a hacker house or what we called a hacker house. I guess it was actually just a suburban house, and I'm not sure the neighbors were super
mm,
happy that it turned into a hacker house.
mm,
It wound up pretty degenerate. I think four of us were on the lease. At some point we were 15 people in the house. There were people sleeping in the
oh my
living room, in
god.
the basement. We've since graduated from that, but we basically got a house with like a bunch of other founders or very, very early stage founders who either had not raised money or very, very little, or sort of just in the ideation stage as we were at the time. A bunch of kids from like Harvard and MIT. So that was, I guess, the continuation of the college story while starting the early days of the startup slash like
Yeah.
late stage college. But that was definitely a
Yeah.
very like, formative period for us.
Yeah, that's sweet. What was it like living with your co-founder? Cedo's mentioned it a couple times, and I'm like, we would tear each other heads off within like a week or two.
I don't know how people would do it if they just lived with their co-founder or just with their own employees. I think for us it was easy. Like it's also a very big house. He lived in like the roof attic. He had like a palace up there. I lived like on the other floor with like three other bedrooms, and it was I would let's just say I was very jealous of his attic because there's a lot of noise on my floor. I think it was I mean it was great. Like I have no complaints. I think we had like there was a lot of just like learning generally in that house because everybody was working on something or was like thinking about working on something. So we didn't buy any furniture. I think we got a couch from the street that we called street couch. We got like a picnic table that was we never bought a dining room table. First we were sitting on the floor, then we got a picnic table from outside and put it inside, and so we would often sit around the picnic table on the benches in the dead of winter in Boston, just sort of like talking about markets, talking about building companies. It was a very like generative time. I can only recommend it because my experience it wasn't the most luxurious, but it was definitely sort of ripe with like learning. I don't know how people would do it if it was maybe just their co-founder or like just some employees. I think that might be a bit much. But yeah,
Was this you said this was during college or right after college?
it was right after college. Yeah, when we were just sort of in the like idea phase.
Yeah, and you touched on kind of our next question of the exit liquidity moment. I guess we share some similarities of Luna and Anchor. I saw some like older tweets and you shared some memes that you've had kind of calling out that system pretty early on. Um, Give me some insight into the exact kind of like moment where you wake up and you're like, crypto is something valuable and it's something that I want to build in. Is it, like at an internship? But what kind of happens there that makes
Yeah,
that decision?
it's a good question. I mean, I think like most things that you develop like an interest in, it's sort of like very slowly and then like all at once. I think this is probably what happened for Ballet. I honestly don't even have any memory because I started so young. I just remember being conscious and being obsessed. Um, I I don't know if there was a single like switch moment with crypto. I think probably one of them was actually like stable coins. I haven't really talked about this, but like I distinctly remember having one conversation with like my boss when I was at Bridgewater at the very end of my internship, talking about like money market funds and stable coins and sort of like the analogy between them. And some, I don't remember exactly what it was about it, but it was basically like the concept of being able to graft, I think, like systems and market structures from like the traditional markets and have some sort of like more efficient, basically, it was like the concept of like drawing the parallels between like the traditional market structures and what we were building on chain, that like something clicked. But I mean, the story goes back a lot further than that. Like, I think I mentioned I grew up with a very like libertarian family. A core like formative moment of my childhood was, I think I told you guys this, but my dad, after 2008, after the great financial crisis, and they, pumped liquidity into the system, he was very paranoid about inflation. He grew up in Germany. He grew up in West Germany, but he had family in East Germany, and so it sort of, grew up visiting them, and I I guess grew up with sort of this like in the back of my mind stories that I heard about sort of like the ravages of socialism or communism, as well as stories of like sort of like the Weimar Republic, obviously, which he wasn't around for, but he had family who was around then. And after the great financial crisis, he was very paranoid about inflation, and I distinctly remember that he had a phone case for probably 3 or 4 years that was a custom printed phone case of 100 million Reichsmark, which was like the highest denomination of the currency in the Weimar Republic when they got into hyperinflation. So we didn't get the hyperinflation maybe some who were more paranoid about the Fed thought we would get at the time. I don't know that we'll get it this time around, but if we keep going down this path at some point, I think we will. And so I was definitely like primed from a young age, I think, to be like interested in a lot of the like sort of ideological foundations of crypto, either on the sort of like general libertarian side or on the like hard money, non-government money, sort of like gold bug analogy side. And so I think that's like when I first heard about crypto, there was it naturally like made sense, or it seemed like the kind of thing that I would be interested in. And then I think probably what then got me to go down the rabbit hole further was finding it just really incredibly confusing. Like, I find when I don't understand things, or I can't immediately sort of grok or get like a lay of the land, it's like infuriating. And there was so much like going on during DeFi summer, and so many, like I wasn't really in the trenches deeply at that point, and I would like read these white papers, and then try to like move around in DeFi, and found it infuriatingly confusing. And I think I just like I would just keep reading until it sort of made some sense to me. And then I think at that point, once it sort of like started to make more sense, I was so deep down the rabbit hole. And honestly, I mean, yeah, maybe we're just like masochists. Like, we committed to building like in the depths of the bear market. That was when we were like, all right, now's the time to build. Like, I actually want to dedicate my life to this. Yeah, hopefully that answers your question. I think it was this like slow like priming from things I've been exposed to from a very young age, combined with like a deep desire to actually understand it. And then like maybe lastly, I guess the sense that like I just also like the people that I met in the space. I think people sometimes complain, but I spent some time like working in a lab when I was in college, which was a great experience. But one thing that struck me was how slowly things moved, which I found I couldn't imagine like dedicating the next like 5 to 10 years of my life doing like research where the feedback loops were like months or years. And one thing I like loved about when I started doing stuff in crypto was how quick the feedback loops were. And sometimes those are, sometimes that's very tough. You get very negative feedback loops very quickly, but things, and there are obviously downsides to space moving incredibly quickly. I think we're like super ADD as a space, but it is, if you want to ship fast, if you want to move fast, if you want to be in a space that's like evolving rapidly, which was like, I wanted sort of the antithesis of like what I had done in Ballet, in a space that is like effectively frozen in time, and like largely doesn't move forward at all, because your job is to sort of like preserve an art form that's been around since like 1750. So yeah, hopefully that sort of makes sense.
And I also see a lot of the kind of connections that you're mentioning that are tying to Ostium and like general commodities and RWAs, and bringing that on chain. Can you kind of give us the high level thesis that Ostium has?
Sure. So basically, off of the sort of back of like a lot of the time that I spent working at sort of various hedge funds over the summer, one sort of core thing that stood out to us was it seemed like something had sort of broken in the financial markets, or COVID had sort of broken something in the financial markets, and that we weren't going to see the paradigm of the last like 10 to 15 years since post GFC anytime in the near future. And what I mean by that is basically like secularly or persistently higher inflation and like persistently higher interest rates as a response to that. Um, and and so I guess the general thesis was like, if something is the developments that have happened in the last 10 to 15 years on sort of prosumer and just like general access to trading, this is totally outside of Web3, have mostly focused on equities, largely because equities are like the asset class that has performed really well since the GFC because of like very permissive monetary policy, sort of tech and growth equities. Um, and I guess we came to sort of like general view that the innovation going forward would be disproportionately focused on like non-equity assets, so like commodities, on FX, but like indices, maybe sort of to some degree in that category, but let's say like largely commodities and FX, and that those markets, especially for like prosumer access globally, or like retail, I say prosumer because it's sort of like the more, I guess, like professional consumer, um, that most of the innovation in terms of like market structure and like democratizing access to those markets would be focused on those markets rather than equity markets and everything that had happened in the last like 10 to 15 years since the GFC. And so that was sort of like the high overarching thesis was like, if there is innovation in general prosumer access to markets, uh, most of it has happened in equities and been disproportionately focused on that in the last 10 to 15 years, and probably going forward it's going to be focused on a lot of other asset classes, especially commodities, maybe FX to some lesser degree. um, and yeah, so that was sort of like the non-crypto thesis. The sort of crypto thesis, and like you'll see where these two come together, was all of this, if you like believe in where the space is going long term, all of this stuff will ultimately be settled on chain. There will be a market for all of this, and that will settle on chain. And the general consensus view seems to be that the way that will happen is through tokenization. So basically applying like the Circle and Tether model that has worked well for stablecoins and to some degree treasuries to everything else. And so basically that is, a centralized off-chain holding company holds an asset, mints an on-chain equivalent. You have to some degree, largely free transfer on-chain. And then there's like a redemption mechanism to redeem it for the underlying. And I think that's worked really, really well for stablecoins for obvious reasons. And for treasuries as well, as like interest rates have gone up and people want to hold treasuries. But I guess the thesis is like, that's probably not the right model for everything else, especially for assets that people largely want to trade and don't necessarily want to hold long term. Like it's very obvious like why you want stablecoins to be some composable token, because it's a store of value or a means of exchange. With treasuries, people want to hold them because they're yielding, and often it'll be DAO treasuries or people who just have a large portion of their capital on chain and want to hold something that's yield bearing. I think for a lot of the other assets that there will be demand for having these on chain before there's demand for long-term holders to just sit on them passively. A better model for actually enabling like on-chain exposure to those assets is what I will call perpification. So basically bringing that asset on chain synthetically through in the same way that you would for listing like an on-chain perp on an asset. And I just want to like quickly pause on the synthetically aspect. When I say synthetically, I think people often associate this with like an over collateralized CDP, or some like synthetic version of an asset that itself is a composable token. Actually, think like people have tried that model before. Like Synthetics early days back when they were like Haven or like Mirror, many others. And I think it hasn't worked for a number of reasons we can dig into more if you want to go there. But the model that I sort of mean when I say synthetic in this sense is as effectively a perp. So as without actually having the underlying be on chain. And so if you want to list something as a perp, you kind of only need three things. You need a market that matches buyers and sellers, you need a funding rate, and you need a spot price. And I think before us, no one had really solved for sort of like all three, in a way that allowed people to scalably bring these assets on chain. And I can talk more about that in a second. But the sort of like crypto native thesis, in contrast to sort of the general like Web 2 thesis and like where a market's going and like what is going to be democratized, is this stuff will come on chain, and almost certainly it's going to come on chain as a perp or as a derivative first before it comes on chain as a sort of like tokenized spot product. And I guess I'll pause there, but I think like the intersection of those two is basically the assets that we are most excited about, like bringing on chain, because that's where we think the most innovation is needed based on like where the sort of general macro direction is going in the next 10 to 15 years, was first on commodities, but ultimately on every asset.
Mm. Yeah, yeah. It's definitely, after like reading into it more, it's definitely like an interesting contrarian thesis of going in the direction of creating perp markets for these assets first rather than going the tokenization route. I think like people just kind of assume that that was like, or at least I kind of assumed that that would be like the standard. You know, eventually we would put this stuff on chain
Yeah.
in the form of tokenized backed assets in some way. But to hear it like flip flopped, you know, first let's create markets so people who, you know, may not have access or may have an option to get easier access can start to use the products first, and then we move on from there. How does like tokenization play into like Ostium's long term thesis? Do you still think it has a place like in the RWA space longer term? Do you think that it like is ever gonna come close to what you expect to see with perps?
So for sure, I mean, I think it's again, if you like just believe in the fundamental like value of having this like open system for settlement and as sort of like a financial settlement layer, then these assets will exist in some composable and tokenized form um, that will be able to be just traded freely on chain. Um, I would I would say that I think where that will really hit an inflection point is when the issuers of the assets like start to consider the blockchain as like the ledger of record. I guess my quibble with like taking the like stablecoin model and applying it to sort of trying to apply it to like every other asset is you do inherit, I mean, you obviously get like instant settlement and easy cross-border transfer, which is largely why I think obviously it's so important to have a tokenized version of a dollar exist, or like a digital dollar. But you inherit a lot of the um I guess like issues of the underlying market if you're just creating you don't if you're not creating the reference market on chain, then you don't fully get rid of the issues of the underlying market if you're trying to improve like that market structure. If you're just sort of like replicating the market on chain and having like another instance of it. Um, and so I think all of these assets will exist in some form, but it'll probably for many of them, it will reach escape velocity when the issuers are comfortable, like would issue them themselves on chain, rather than like some third party sort of like tokenizing it and creating some version on chain that is like accepted by some and not accepted by others as like an official form of the asset. And the other thing I would add to that is like I think part of the reason this seems to be consensus is because, well, one, it's like worked for well for stablecoins, but is because people seem to think that you need to be sequential. Like you need to have like the spot market on chain, and then you might have a derivative market or like a perp market or some other market. You don't actually need to do that. Like you need a spot market to have a perp market, but no one said that spot market doesn't need to exist on chain. You could have like an entire, um, you could have all of spot for the majority of Bitcoin be traded off chain and then have a perp market, on Arbitrum or something on Bitcoin without ever having some off-chain perp market. So you can have like, so long as you have a liquid spot market and you have the means to create like a perpetuals market with those like three things that I mentioned being like the market to match buyers and sellers, the funding rate, and the spot price, that can come on chain first. And I think given like where we see like demand and like trader behavior um, going, that will almost certainly the perpetuals market will almost certainly come first and be larger for a very significant period of time before that like tokenized spot market effectively moves on chain.
Yeah, I agree. I think like the perps market as like a normal crypto user is just the most interesting, most fun, easiest to use. And
Yep.
when you start involving like options and all these complex things, it's like up or down is like easy enough. So I think the reasoning for like the growth of perps in general across our market has been kind of like that ease of use. And I
Yes.
have questions on how you feel or how you're observing tying that to commodities. I think a lot of the people on chain probably have never even thought about trading some of the things that you guys allow for trading. Could you give us some insight on like how big this market is, and how you feel like you guys will be able to attract those crypto native users to something new.
Yeah. I mean, uh, there's the meme of everyone is actually trading digital commodities, but I'll leave that aside. So in terms of just the general commodities markets, I think people underestimate often, especially within crypto, like how large these other markets are. I always find it a bit ironic that RWAs, or real world assets, are considered a niche subset of crypto, when in reality, like with RWAs being the entire rest of all other financial assets that are traded, when in reality, crypto is obviously like a niche subset of the entirety of all other financial assets. Um, so I think what you're getting to is, how do you bring what like deep crypto natives might consider sort of a more boomer asset class, and make it interesting for the people who are on chain today. And again, this is where like sort of perps come in. The simplicity, you mentioned this yourself, but the simplicity, up or down, the lack of expiries, in perps are, I would go as far as to say, I think like perps are the 0 to 1 financial primitive innovation in the space. And um, I think that everything has happened until now in the perp space is basically like a prelude to what I think will be a much larger market, which is basically a perp like instrument on all other assets that have a liquid underlying market and could, in theory, be rolled into a perp like instrument. Um, and so when it comes to sort of like packaging this in a way that is appealing to crypto natives, I think giving them, part of that is like UI. Like I think we've if you haven't used the app, feel free to use it. We'd love to see you on it. But there is, and actually, quick plug, we're doing a trading competition right now. So if you want to climb the leaderboard ranks, it's there for you. But we've like sort of presented this in a way that like looks and feels very crypto native, and looks and feels like a perps dex that anyone might be familiar with, but just gives you access to other assets that you might never have thought would be tradable on chain, all like from your wallet and from the sort of same interface. So I think a lot of this stuff is really like just is like packaging and giving it to people in a way that feels, when they hear some esoteric commodity that they've maybe never traded or have not traded until, or haven't traded like in a crypto context, um, it might seem very abstract or very removed from what they're doing on a day-to-day basis. But if you package it in a way that feels very familiar and has all of the same properties, from funding rates to sort of the simple structure, the leverage, et cetera, of like trading perps, I think you'll see like a mindset shift in terms of people, how people like approach interacting with these assets.
Hmm. Yeah. Let's I think that's a good spot to like get into the how a little bit. You've mentioned you need three things to offer a perp market, essentially: a funding rate, a market to match buyers and sellers, and a spot price. Starting with the spot price, how are we getting that on chain for something like, I don't know why I just love like lean hog futures. I just feel like it's extremely memeable and like untapped in our space. So let's like
Yes,
use that as an example
sure.
for how we're getting that on chain.
We do have lean hogs on testnet right now, so you can
Awesome.
ape those. I would agree. I think we have a few like longer tail commodities that we've put on testnet, um, mostly for the memes: soybeans, cattle, hogs, uh, cocoa. So hogs are definitely my favorite. So in terms of how to create the spot price, so maybe just like a bit of context there is, on the three things that I mentioned for what you need to create a perp, the like market, the funding rate, and the spot price. The two parts I think like people have not solved for before is the market structure, specifically that accounts for like the properties of these assets. So it's not as simple. People often ask like, why couldn't XYZ exchange just or XYZ like normal leading perp stacks like list these assets? The reality is that's not as simple if you want to do it in like a scalable way to just shoehorn it into like a dex that's made for not like for a crypto asset, because you have to deal with the features of those markets, and a lot of that is tied to like how the underlying market performs, or how it like behaves and what the market structure is. And specifically by that I mean, for any of the commodities, how like the futures will roll from 1 month to the next. The fact that you don't really have, when people say like spot XYZ commodity or like spot oil, what they mean is like the rolling front month future, because the spot market is not liquid. It's like the liquid market is the futures market. So how you deal with that roll from 1 month to the next, and then also how you deal with like market closures. So those are the two aspects on like the market structure. In terms of the actual price, and the two answers are related. So, we spent 6 months basically building out the pricing infrastructure from scratch. We spent a lot of time looking at all the other oracles in the space. And we just found generally that most of the focus in the oracle space was on sort of consensus or node agreement. A lot of it was like blockchain infrastructure. And what we needed to solve for in our sort of specific problem is not really a blockchain infrastructure problem. It's like a financial data problem. It's like, where do you get data from the underlying markets? Like, what are the licensing restrictions? How do you aggregate it? Like, how do you backtest it to make sure that it's good? All of that stuff. And that's sort of very unique and different from, I think, like where most people, which makes sense, but have like spent their time in the Oracle space. So we sort of went through like the stack and tried to think through, like, it's pretty modular. Like, what are the parts where we think we have an earned secret and we understand and need to spend our time and where there's really nothing else in the market? And what are the parts where we can potentially leverage like a partner? And so basically the way I would define that stack is like sourcing the underlying data. So how do you like get that underlying financial market data? How do you aggregate it? So what's the aggregation algorithm? Are you doing a median? Are you doing an average? Are you excluding outliers? All of the sort of math there. Then assuming you're running this in parallel across like multiple nodes, how do you get to consensus or single price across those nodes? What price report do you emit? So how does the metadata get structured? Sort of related to the second point, but different. And then like verifying that price on chain. So looking at that sort of like stack, the parts where we needed to have like, we were very opinionated, let's say, was how to source the underlying data, how to aggregate the underlying data, and what the structure of the metadata should be. Because we realized that, and this is sort of where like the market structure piece comes back in, a lot of the way that people were trying to solve these like market structure problems, so on like market closures and stuff like that, was through what we would call like much more like trusted or like not trustless mechanisms. So like a front end block when the market is closed, or like setting a reference price to zero or something like that, where something can go wrong and it's not really, really scalable if you want to do this at scale, and it requires sort of like consistent human intervention. And so one way that we thought of to solve that is basically to modify or like ensure the structure of the metadata. So like the actual price report that is being passed on chain contained a lot of this other stuff that we would need to use downstream. So like, is the market open? Like which contract, or like not just a midpoint price, but like bids and asks to better reflect like the liquidity of the underlying order book, or like of the underlying market, and those sorts of things. So going back to the hopefully going sort of full circle, like going back to on the pricing side. So how you construct that spot price is you need to source data from many different data providers, and there's sort of core aspects like where you can get it. So a lot of the exchanges won't actually give you like a data licensing, like a data license if you're using it for like a blockchain purpose. So you have to go to like third-party data providers.
Why is that? Do you know why that is? Why wouldn't they provide to
Um,
blockchain providers?
Without like calling out, like specific exchanges, they make a lot of money. Maybe like one interesting just like piece of context is it is so insane that in crypto you can get like an API, like an API with really, really good quality data from like all of the leading exchanges, and this costs you like basically nothing, or like it's just free. Um, that is, I would be shocked. I actually be very impressed with our industry if in 5 years that's still the case. If you look at the traditional market, financial market, like data world is like there are a ton of like intermediaries. There's a lot of money in that sort of like financial data, and the more granular you get, and the more especially for stuff that's real time, it gets very, very, very expensive, right? So if you're like a Bloomberg, you're charging people tens of thousands per seat per year for access to a bunch of real-time data, but they are very protective, obviously, about I guess similar to what like Netflix did with cracking down on people using someone else's account. You can think that in the financial market data world, this is like to the nth degree. You can't like just export that data from your Bloomberg terminal and just use it wherever you please. Like it's only within that contained environment, and any of like the direct exchange data at any of the major exchanges is like this. The licenses are like tens of thousands of dollars a year, and that is for generally consuming that data in one environment, not for redistributing that data freely. And so to get like license to distribute it. Usually needs to be like a derived data license. So you have to do something to it so that no one can actually back out what the underlying data is. And there's crazy stories of like the providers of this data, giving someone derived data license, then the person who, and then basically running a bunch of models and figuring out that you could in theory have derived the underlying data and then suing them for it. So
Mhm.
it's sort
It's
of
a
a
mixed
crazy
up
world.
world, sounds like. Yeah,
I mean, like, there's a lot of money in it, and
for sure.
everyone's just optimizing for their their best incentives, but you need to sort of understand like how to navigate it. And um, it was very clear to us like we were not going to be able to get like direct exchange, like first party direct exchange data. And so you kind of have to figure out like where else you can go. And the other thing to point out is, especially if you're then going to sort of these like third party data providers, they're going to give you data under different formats, and they're not all necessarily going to be referencing the same contract, and they won't even tell you when they're jumping from one contract to the next. So you kind of have to figure out like, so it's not just in sourcing the data, that's just where like the aggregation comes into in the metadata. Because if you're not, you have to be able to account for the uncertainty of like, this data provider might jump to the next month contract 5 days before the last one, and the next month after they might jump 10 days before the last one, or it's not predictable. And so you basically like need an aggregation algorithm that allows you to like account for those properties without you needing to like manually intervene on a monthly basis, which obviously is not decentralized and is like not scalable. I've been ranting for.
Yeah, I don't want to. I know that like the data space itself is like a whole, like that's a whole can of worms that we could get into.
Yeah.
I don't want to get too bogged down with that. Um, let's jump forward a little bit. So we've
Yeah.
got our spot price on chain now from a variety of different data providers. Accounting for things like market closures, midpoint prices, bid ask, all that fun stuff. We put that on chain via an Oracle network, and now I go on to Ostium and I want to place a trade on that market. Can you walk us through like what happens to my liquidity as I go in and start to trade?
Yeah, sure. So we have, I'll give you a quick overview of the high level liquidity model, and then we can walk through like the movement of your capital when you submit a trade. So it's a like Oracle based AMM system in our V1. Um, that means that basically it's a three-sided market. So there are liquidity providers or insurance fund providers. I can go more into that, but there's sort of a two-tiered liquidity system. So we think of LPs as more insurance providers than direct immediate counterparties. But there's that agent, there's then a taker, and there's sort of a maker or like an asynchronous maker. So in that system, basically funding rates and opening fees that scale based on skew in open interest will incentivize the pool or the traders towards balance and minimize the delta exposure for LPs, with the important caveat that obviously if you are LPing into the protocol, you are taking on the risk of potentially being the counterparty or of taking on the sort of like net delta across assets of traders. That said, the fee structure is designed, I think, hopefully very thoughtfully, and we'll see. Hopefully, at scale, this works to incentivize like balance across those parties. So when you are a trader, if you want to open a trade, there's sort of two things that determine the price that you pay to open your position and what your costs are. So we think of the way pricing should be determined as a function of, especially on these assets, of the liquidity on the exchange and the liquidity on the underlying exchange. So the liquidity on the exchange, where that comes into determining your fees, is on the opening fee. So if you're increasing the skew, you will pay a higher fee, especially as well if you're using the last bit. There's a sort of small other aspect of the opening fee that comes into place under circumstances of really high utilization, which is where if you're using the last 20% of the open interest with your trade on a pair, because you are increasing utilization, there's an additional like utilization fee that comes in that only kicks in if your trade is like using that last bit of open interest. That can be scaled to be more or less aggressive depending on sort of like risk management and how we want to scale those caps, and how aggressive we want to be about penalizing people for using up utilization. And then there's obviously the funding rate, which erodes your P&L or adds to your P&L progressively over the period of time that your position is open, depending on how the skew has changed. It's worth pointing out that that's a velocity-based funding rate. So one sort of core thing that we thought about, I think, is particularly important given our markets, where the like sexdex arbitrage that people are doing between, say, Binance and GMX or any other platform, is going to be just less developed at Genesis for us. You can think of like the carry trade that people would need to conduct to incentivize balance while hedging their risk on our platform is effectively being very similar to what you would do if you wanted to basically like collect perp funding on GMX, let's say, and then just remain neutral to the price of the underlying asset by then holding spot off chain. It's very similar. The difference just being that the other leg of that trade would not be on Binance, but it would be on interactive brokers or wherever it is that you would be able to get exposure to the assets that we're listing. And because that sort of like piping that arbitrageurs would be setting up will be less developed at Genesis, we needed to be able to be both aggressive enough on funding rates because people will need a more aggressive funding rate in order to be incentivized to set up those systems to actually run that sort of carry trade, but also be able to account for the lag that we expect to be larger given the fact that these systems are still being built up. And so we have basically a velocity-based funding rate where the rate that you pay is basically an integral of the prior imbalance rather than a reflection of the imbalance like at time t. And we can basically adjust. We work with like Chaos Labs on adjusting risk parameters. We've worked closely with them and we'll continue to after launch on the way those parameters in terms of like velocity and how punitive we are in the funding rates should be adjusted based on, I think, how quickly we see the market reacting and people basically coming into like ARB those funding rates. On more volatile assets, especially, I think it'll take longer because on less volatile assets, people will often feel comfortable taking on, large amounts of exposure, dollar notional value exposure on the euro, let's say, if there are being funding rates that are 80% annually and the intraday volatility of the euro is like sub 50 basis points, than they are on something like natural gas, where the intraday volatility is like 5 to 10%. So you definitely would want to be hedged on that gas probably if you're managing your risk well, whereas you might be more comfortable not hedging out your risk on the euro if you're getting paid like pretty aggressive funding. So that's on the like velocity based like funding rate system. Mention the opening fee as well. Then I want to get to the part that is the off-chain liquidity. So I mentioned like when we determine pricing, we want to think about two things: the liquidity in our exchange, but a core part that we think other people have largely or just period not accounted for at all, that we think is critical to preventing the sorts of like front-running risks or preferential on-chain execution, shall we say. I think that we've seen on some other Oracle-based systems is actually including a measure of the liquidity on the underlying exchange. So part of that, I think people often conflate two things. Like one is actual Oracle manipulation attacks. So like pumping the underlying asset and then, buying right before you pump the underlying asset, knowing exactly where the Oracle is pulling prices from. You saw this with, some of these exchanges like a year and a half ago. Since then, they've updated their Oracle systems and I think are much, much more robust, but that's definitely a risk that can happen. I would point out that for the assets we're listing, this is like way, 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 way less of a risk. Like good luck moving, like pumping and dumping the oil market or the gold market with anything near the size that you would be able to trade, at least in the early days. Our hope is this is a trillions of dollars market and ultimately, at some point exceeds the size of the underlying market. But at least for, I think, where we are today, it would be very, very, very tough to manipulate the sorts of markets we're listing that are extremely liquid. So that's much less of a risk. What I'm talking about more specifically is when volatility blows out and when spreads blow out. This is usually around like market reopen or market close, or when there's some event like Powell speaking or the CPI print is coming out or there's some geopolitical event. Then you usually see sort of like spreads blow out. And if you don't reflect that in the price that you're getting on chain, on Ostium, you run the risk of people basically being able to run these strategies where they're sort of getting very preferential execution on chain, and we're not actually reflecting the risk in the underlying market. And so this is where like the metadata structuring comes in for the spot price. We include basically like bids and asks, and then we like linearly scale those. So we get a best, it's not perfect, but it's like a best approximation of the execution price that you would be getting for your size trade in the underlying market. So that's sort of like what determines the execution price that you get. And then all of the other sort of fees are mostly taken out of your P&L. So hopefully that answers your question, but that is the process. Like that is what you pay, and those are your costs when you open a position.
Yeah, yeah, no, that makes a lot of sense. Clarity definitely helps there. We talked about this. We talked about this earlier, I think last week or maybe a couple days ago. For if I'm a liquidity provider,
Yep.
at least in its current state on Ostium, providing stable coins, you have a single asset collateral pool that margins trades and earns fees as a result, which is similar to models we've seen in the past.
Yep.
And there's obviously been some critiques of that model in the past. And I particularly liked your answer as to why you think it's the right fit for Ostium currently in its current state.
Yep.
To to go back to, we had Kellen from Parcel on a couple months ago. Great
Yep.
guest to go. They have a
Great
similar
podcast.
liquidity model. Yeah,
Yeah.
awesome. Um, his response. They run similar infrastructure, obviously. His response to that was, these are markets that are, obviously not nearly as volatile as what we've seen it used for before. Real estate, you see very very low level of volatility, single percent movements
Yep.
over the entire year, and keeping fees and funding rate punitive to the point where we can't see a crazy level of skew is a good way to take that first step and have a healthy enough system. uh, for Ostium specifically, what's your approach as to why that's the right model thus far?
So cool. It's a great question. So first, I'll maybe talk about like why I think this model makes sense and why we designed it this way. And I just want to caveat that like I don't think that like long-term Ostium will not look this way. This is what makes sense for a V1, but not for V2. And then I'll talk a little bit more about sort of like more nuance, like how the risks on Ostium differ from those on Parcel for liquidity providers based on like the structure of the market and the exchange structure. So in terms of benefits, um, the core answer is it enables us to rapidly scale to new assets, long tail assets especially, that you would be hard pressed to under the current sort of like market structure and the way that most market makers interact with on-chain would be willing to underwrite as a market maker or willing to actively market make on. Uh, and also does not make us dependent on sort of third parties, allows us to pull from pooled capital to list markets very quickly. So it basically gives us the scalability benefits that are sort of the whole point of the system in the first place, which is like, I mentioned this earlier in sort of the broader thesis, but perps are a much more scalable way to bring a lot of these assets on chain than having to sort of like individually run the tokenization playbook for each of them. And we get that to the most, we like play out that sort of version of the world to the nth degree when we actually have like a pool, like shared liquidity that we can tap into and really scale to like list basically any asset. Obviously, no long tail asset would take up some significant proportion of the pool, and this is why there are caps that are determined that are like a function of longer tail assets will have a much smaller cap than sort of like blue chip assets, but does allow us to list them quickly without needing a market maker to make those markets. So that's sort of one um, in terms of like the benefits and why we have this structure. And it also just maybe one more thing to note is like it just allows there to actually be like good execution. Like even if you could like run your own market making strategy on some of these like long tail assets, you're not going to get like people are not going to get great execution on like hogs or cattle from day one until there's like a and here, basically, you get good execution from day one, but the compromise that you're making is there are caps to the size that you can take on. And that's like a natural way to manage that risk. The caps exist so that you can't get perfect or great execution, the underlying market execution to an infinite degree. So that's the trade off that we thought was like worth making in this first version. Because also, you're not going to be able to, for something really long tail, you need to give people a good product experience from day one to actually think like prove out the thesis of these markets being valuable to have on chain. So if you have a horrible execution, you're not going to get a good product experience. In terms of like how the risks I think differ from maybe Parcel specifically, the core thing to point out is like um, these are markets that update every second. Like we produce a price report every second. So a lot of this actually ties back into something that you'd mentioned earlier about like how do you get crypto natives to care and like how do you package this in a way that feels familiar. This looks and feels like a perp stacks. Like it is, there's a price, it's coming in every second, it's updating regularly, the thing moves quickly, You can sort of see, like, it feels alive, right? There's like a band of like the trades that are coming in. I think at any of the sort of like major perp sexes, when you see the orders coming in, you see the order book, you see the price moving, like it feels alive. And that is definitely how Ostium feels. And the flip side of that is if you have prices that are updating every second. I think in the podcast that with Parcel, one thing he mentioned was like the prices update once a day. That's great for risk management. I would maybe argue that's like less good for the sort of like user and product experience. But for us, it is definitely more of a risk to have these prices update so frequently, because you could see very, very large intraday swings during periods of really high volatility, say what happened during COVID, or any of these other crazy events. So that is a greater risk. The flip side of that is we don't just have one asset class. We have lots of uncorrelated or anti-correlated asset classes. We wrote like a research piece on this, which, if you want to check it out, you're welcome to. It was a piece we wrote on something we call the imbalance score. So like the point of the research piece was we were trying to quantify if you have a bunch of imbalances or a bunch of like delta skews across many different assets, some of which are correlated, some of which are anti-correlated, some of which are just uncorrelated. How do you quantify the total risk that the pool is taking on? Because it's not as simple as like, imagine you have a 5 percentage point skew in long in Bitcoin, a 5 percentage skew short in ETH. To some degree, they're hedging themselves because they are correlated. So, I don't think there's a perfect way to do this. Obviously, I mean, there clearly isn't. But what you can basically, and this is like very basic, sort of applying modern portfolio theory, but is if you have a bunch of assets that are less correlated, you do get less risk for the same unit of like delta exposure than if you only had correlated assets. And I think a good like example of this affecting protocol design is I would characterize the original GMX V1 objective function as minimizing long risk, right? Like they designed the entire DEX where you can only trade the assets that are also in the pool. Why? Because if someone makes a lot of money going long, at least having that asset in the pool, that asset will have appreciated as well. And so like the objective function was like minimize the risk from people making money from going long, because it's very hard to short crypto effectively. Whereas here, the objective function is like minimize delta risk generally. And the probability that like every single asset we list across many different asset classes, many of which are generally anti-correlated, would all go in the same direction at the same time is unbelievably slim. So I think we get like diversification benefits from what we're listing that you don't get when you have a single asset class like just crypto or just real estate or just metals, let's say. So that's like maybe another core thing to point out.
Yeah, I think from usually like every episode, what I enjoy about these, I have like a little light bulb moment depending on the conversations, and I think what I'm kind of hearing is that you guys are not only taking kind of interesting price feeds or interesting data from somewhere else and throwing it on chain. You're taking like a very complex market and bringing it on chain in a very simple way
Yes.
for us. So I think that's kind of the interesting takeaway I have. In your guys' documentation, there's the word indices thrown around. Um, I think Ali and I, our first like research papers where we talked about like leverage looping was like I think mirror protocol and the stuff you could do on there. Um, how far do you guys plan on pushing that envelope for what is able to be listed and traded?
Yeah. So, I mean, the vision is any liquid market on Earth can be traded as a perp on Ostium. The vision is we want anything that people might want to trade sort of actively, or that like a prosumer would want to trade actively, going long and short, to be listable on Ostium. These are the largest, the most liquid markets on Earth. So the answer to your question of how far we want to push the envelope is far. We want everything to be on Ostium. Um, the question of how we go about that and what the listing strategy looks like, I think, is a separate one, and like the path to get there. So I would just to quickly spend some time on that. I would characterize the listing strategy as focused on a core set of assets that we think will be the majority of our volume, and those would be G10FX, gold, and oil. I think if you look at like leverage trading platforms, Web2 leverage trading platforms, that's where you tend to see the majority of volume. This is all ex-US. But then listing assets when they are in the meta, in the same way that I think that perp dexes like Avo and Hyperliquid have done really well with pre-launch tokens. Um, the pre-launch, like the hyperps or whatever Avo calls them, are like less than 5% of their total volume, but they are great at one, attracting attention. It's great marketing, and also at converting new users, where this is the only place for them to trade this sort of thing. So basically capitalizing on when an asset or protocol is in the meta, the token is not yet live, and being the only venue and the first venue to turn that into like a financially tradable instrument. And it's somewhat analogous, I think, for how we will think about listing new assets. When something, a good example of this is cocoa. About a month and a half ago, there was a blight on all of the cocoa trees in West Africa. The price of cocoa, I don't know if you saw it, but it went banana zone. It went past 10K. I think it's dipped to something like 8K since then. But I had, after I had about the seventh person send me a picture of a cocoa chart, I was like, right, we kind of got to list this. And based on our existing data providers, we were able to move like pretty damn quickly to list cocoa. Obviously on mainnet, we would do a lot more sort of like soak testing, but on testnet, it's not real money. And so we listed cocoa within 24 hours. So that is basically capitalizing on what people are interested in, what is either experiences some crazy move or is relevant to the meta, and then moving quickly to list that. So that's how I would sort of characterize the listing strategy. I think there are a lot of like analogs to what other perp dexes have done within crypto specifically. Maybe last point on this, sort of like how far do you want to take this? I think you might be alluding to indices and like how you could compose across different assets. I think one really cool thing that we've been thinking about and we'd be implementing over the sort of upgrades post V1 is having basically composable vaults on a lot of these assets. So I think I actually have this on the landing page. There's like a carnivore index, vegetarian index. This was sort of a cheeky joke. The idea was, the carnivore index would be hogs and cattle, and the vegetarian index would be, soybeans and, corn and wheat or something. I thought it'd be quite funny. But the reality is, if once you have these assets on chain, anybody could, in theory, you can compose a vault on top of that and have like a user-led index creation process. That doesn't require us to determine what should be the composition of those indices. And I think that's where things start to get like very, very interesting. Once you have some form of representation of those assets on chain, you can basically leverage, permissionless nature of market creation on chain to have people create these composable indices on top through vaults that allow you to sort of like speed down the process of index creation that exists off chain and have the market sort of discover which ones are best. So that's one thing that I think we're very excited about.
Yeah, that's awesome. I think playing off of hype cycles and being quick to kind of meet user demand when it shows up in these quick bursts is something that's really been proven in crypto and with tokens at least. It's been massively successful for Hyperliquid. It was for Avo and Drift for a time as well too, and to have so much of a bigger asset pool, other asset classes even included in that is opens up a huge world of opportunity. I have one last question before we wrap up. I know we're at time here. You are also free to answer this as you will or decline to if you'd like as well. But people obviously always want to hear about path to decentralization, whether or not their activity means anything at this point. Is there anything you can share on that to this point?
I figured I might get this question. So without saying anything specific, obviously, we're building ONCHAIN because we want something that is to some degree or increasingly over time immutable, or at least governed by a community and a set of users. I do like genuinely believe in, and I think this is honestly one of the most, I found the most successful ways of converting people who are crypto skeptics to actually maybe be interested in crypto, is the concept of like the users owning the network, and like early users benefiting from the success of the network as a whole, and that sort of bootstrapping. So I believe very sort of like firmly in that thesis, and I want that to be the case for us. I obviously can't disclose anything specific in terms of what we're working towards the next 6 to 12 months, but at least for the time being, for now, We do have a testnet trading competition running. So there is a very explicitly incentivized testnet trading competition. We want to incentivize you to stress test, try to break our protocol, please. We want you to try to break it now before we go on mainnet. So there's 10K in prizes if you want to participate in that. And then, over the course of the next 3 to 6 months, we'll be obviously announcing more in the way of sort of like direct incentives and how people can participate and, know more in the way of how they'll be rewarded for that. But yeah, I'll leave it at that.
Cool. Yeah, great stuff. One last thing, just to kind of put a bow on everything. We've talked about a lot of stuff, obviously. I want to give you a sort of challenge at this point. So, Ostium is obviously a perp dex for RWAs broadly, looking to perpify everything. In the next, just for the people who maybe missed the last hour or so, can you just give us a super quick rundown, 60 to 90 seconds, of how it does so and why we should care?
Sure. So Ostium is building the infrastructure layer for the perpification of everything. The way I would define perpification is in contrast to tokenization, which relies on centralized intermediaries and centralized off-chain holding companies to create off-chain equivalents for real-world assets. We rely on the decentralized network of users and arbitrageurs who incentivize the system towards balance. And all we provide there is a market structure for matching buyers and sellers, a funding rate to incentivize balance, and a spot price to enable listing of these assets. So we've basically built the infrastructure layer that allows any asset, starting with commodities, FX, and indices, but ultimately every liquid market on Earth, to be listed as a perp-like instrument. And we fundamentally believe that perps are the 0 to 1 innovation in the space, and everything will be treated like a perp. And in fact, that listing things as a perp first, rather than tokenization of the spot market first, is actually the best and the most scalable and the most user-friendly approach to bringing the large swath of non-crypto assets that ultimately would be settled on blockchains on chain. So yeah, from a user perspective, what that looks like is you can use a stable coin to go levered long or short on any commodity today, or any of the major commodities, from oil to natural gas to copper, gold, and so forth, and ultimately to every asset on Earth, down the line.
Awesome. Yeah. Well said. I think that's a good stopping point there. Thanks again, Kaledora, for all this.
Thanks,
It's been a
guys.
lot of fun. Definitely looking forward to trying out the app and everything. And to everyone watching, go try out Ostium on testnet and let them know what you think. That was episode 74.
Thanks, guys.